what we're constantly getting from our community is, hey, Jimmy, help me understand what a real estate tax professional, what first I need to do to qualify, and two, dollars and cents wise, what does it actually get me? And then explain depreciation for me. And as you guys know, I always aim to be not the smartest person in the room or on a call. So to answer these questions, I got my accountant, Marcus Krigler, who is going to work us through all that stuff. Marcus, I'm just going to ask you questions, the questions I'm getting, the questions I have for myself.
Yeah.
And let's get a dollars and cents. Hey, how can I do some math to plan out how much real estate I want to buy, how much real estate I need to buy, and then go from there. Because when people ask me, Jimmy, what are you doing with your portfolio? I say I'm doing what Marcus tells me to do. So I understand the rentals I buy, like my base wealth plan is covered from it. Really, the buying spree I went on in 2016, and now I'm just trying to lever it and expand it. But my acquisition strategy, I would say you are driving my personal acquisition strategy right now. So if you would, why don't you introduce yourself to all the people who are going to be viewing this?
Yeah, sure. I appreciate the introduction. My name is Marcus Krigler. I am a CPA. I'm founder of Beck CFO and CPAs. We are an accounting firm that specializes in working with real estate investors, real estate entrepreneurs, helping them make more money, save more money, and ultimately build wealth. And so we talk a lot about real estate. Jimmy and I spend a lot of time together in his wealth journey and just going through kind of everything from buying rentals to understanding his entities and understanding how everything works. So we do it across the board there. But today we're talking about taxes. And I think Jimmy texted me yesterday and he was like, hey, I got all these questions. What can we do to help get some of these answers out there? And I was like, hey, let's just do a recorded call and see if we can't get some of these answers out there. And then if you guys have any other questions, you can certainly follow up with Jimmy and he can follow up with me, or you can directly contact me one way or another.
So let's start with the first question, Marcus. What is the minimum requirement to qualify as a real estate professional?
Yeah, so a real estate professional, the minimum requirement is very simple. There's two things. You've got to have 750 hours a year in the real estate business, right? So real estate trader business. So that is, buying rentals, managing rentals, developing, construction. There's a whole list of topics or real estate activities.
What about attending mastermind calls?
Yeah, flipping would be a real estate requirement, right? It would go into that 750 hours. So it's just under 15 hours a week. So first thing, you got to do that. And then substantially all.
Is your internet connection all right?
Yeah.
Okay, there's a little delay on my part. What about attending mastermind calls? Would that contribute to the hours?
I think it could contribute to the hours once you become a real estate professional, but there are some stipulations there. I would not count that as all your hours, but I think you could include it in the hours, I guess is the better way of putting it. Does that make sense?
Like that'll add another two to three a month.
Right, exactly.
Okay, cool.
So you're going to do that, and then substantially all of your active income services are over 50%. So that's what they consider substantially all in tax. Over 50% is in real estate. And so that only has to be the case for one person. So if you've got two people in a household and you're married, only one of them has to qualify as a real estate professional to start getting the benefits of real estate investing.
So it's almost like the toughest nut to crack is if you have two people who are married that are both working.
Yes. Yeah, W-2 makes it very difficult.
What about 1099 or business owner?
As a business owner, it's a little easier, especially if the business is in real estate, it makes it really simple. As a 1099, then it depends on what is the 50% of substantial services, right? And how does that play in? Are you getting a 1099 because you worked for 10 hours a month on something? That's very different than working 100 hours a month or 200 hours a month.
Yeah.
And so I think that all matters. What really matters here is record keep, right? Once you make the decision, and again, we're talking, I know we're talking to people that are going to be in the gray area of this, right? And we're trying to qualify. We're trying to do the things to qualify. When you're in the gray area of anything with tax, it's all about documentation. And so what you really want to be doing is you want to be documenting those 750 hours and truly explaining what did you do during that time period. Because if it gets asked, if you are questioned, if you're a high income taxpayer and you start taking large real estate losses and somebody asks you about it, like the IRS, you want to be able to easily show, hey, yes, we qualified. Here's the record keeping log. And guess what? You're going to be one of 100 people that actually could supply that. And so instantly you're ahead of the game.
Okay. And so the way I've seen it on our end is generally there'll be 2 working spouses. And then once people get to 5 to 10 units, then they start looking at this to say, hey, what does it look like if one of the spouses kind of quits their active W-2 and, hey, maybe we can make up some of their income with tax savings. In fact, we have several people in our community who have done that.
Yeah, no doubt. Especially if you are somebody that is wanting to buy, and we all know, I know Jimmy teaches this, one single family rental is something, but if you really want to grow wealth, you've got to grow it in multitudes of single family rentals, right? And so doors matter. And so the more doors you get, honestly, what makes a lot of sense for couples, especially if one couple is a high income earner, or maybe the other person in the relationship is a lower income earner, a lot of times it pays to say, hey, you need to go be a real estate professional. We can take losses. We can also, not only just the losses, right? Well, losses are a great thing, but also the acceleration of being able to grow your portfolio there too, of having somebody focused on it and making sure that they're spending that 750 hours doing maybe a couple more flip keys. Heck, you could probably just do a couple more properties and make up for a lower income spouse pretty quickly.
Yeah, absolutely. Okay, it's going to be 101 as to far as what you need to do to qualify. And so they can work with you, they can work with their accountant to get those qualifications maxed out. I can give you guys the big, broad kind of picture that it's possible. Next, help everybody understand what is this magical thing called depreciation.
Yeah, so the question is, all right, you want to become a real estate professional. Everybody says, be a real estate professional. That's the golden goose. And the answer is why, right? So this depreciation, everybody talks about depreciation. And in the real world, depreciation is a terrible thing, right? You go buy a car, it depreciates, you're pissed, right? That's just the reality of it. In real estate, we have this little sliver of a loophole that they call depreciation on an appreciating asset. And so you buy real estate and the IRS is like, hey, you can start writing this real estate off every single year, over 27 and a half years for most single family rentals, every year for the next 27 and a half years until it goes to zero. And so that's the awesome thing about depreciation is you're writing off an asset that is appreciating in value. Now, what I know you're about to ask about, and I'll just go ahead and take it out of your mouth, is, all right, 27 and a half years of writing it off over 27 and a half years is great, but we want to write it off faster. How do we take some pieces of this and write it off faster? And so what you will hear thrown around is this term called a cost segregation. Now, don't get too confused about what a cost segregation is. It's just a report that takes your house that you purchased and just cuts it up into little pieces, right? So we all know a house is a bunch of little pieces all glued together. Your roof has to be by IRS code depreciated over 27 and a half years. However, your flooring, for instance, only has to be depreciated over 5 years. And so by doing this little cost segregation study, we take assets in the house, flooring, fixtures, landscaping, all of these things that are considered lower lived, depreciated over a lower time period, expensed faster, more money in your pocket. That's what we're doing here, right? We do that, and that now brings all that depreciation forward, and that's the golden goose, right? So once you're able to be a real estate professional, all that depreciation that used to be over 27 and a half years is now front loaded into the first 5 and 15 years. Now there's it gets even better than that, right? And so one more layer to this is this theory called bonus depreciation. And Jimmy, if I'm going too fast, just cut me off here. But this bonus depreciation is something that really has been around for a lot of presidential candidates, right? Or presidential regimes, right? Obama had it, Trump has had it, Biden's still got it. We're looking at improving it again, right? And so there's always been this bonus depreciation, which basically says you can write off whatever the bonus depreciation amount is for that year, all of let me
So
restate.
back up for a
All of-
second. Define
yeah.
what bonus depreciation is. The way I was able to understand it is I had a buddy who, because of this tax plan, he bought a tree cutting business. So because he could get a ton of capital assets right away and get the bonus depreciation.
Yeah. So basically, bonus depreciation says this: all of those assets that we said were 5 and 15-year assets, right? So we originally did this cost seg, and this cost seg broke out all of these lower lived assets, what we call them lower lived assets, the land improvements, the furniture, all that stuff. That is what we can take bonus depreciation on, which means we can take accelerated depreciation in the first year that we purchased that property. So for 2024, the year that we're setting in today, the current tax code says that any lower lived asset, you can depreciate 60% of the value of that asset in the first year. Let's just get to numbers, right? Because it's easier to explain with numbers.
All right, so Marcus, why don't we start with, what should we call it, purchase price or asset value?
Yeah, purchase price. Yeah, because it's always the purchase price.
Okay, so we're going to do this first scenario. I want to see this as a basic turnkey. I'd love to see a Berkey after this.
Okay.
So generally a purchase price of a turnkey is at the market value. So $200,000 house, right?
Yep.
Okay. So I guess the next thing that would be in our little chart is land, right?
Yep. So we're going to take out, generally, you can estimate 20% for land.
Okay.
And there's tax law on how you're supposed to allocate the land. It could be a little more, could be a little less, but we're just doing estimates here.
Okay. So then what is this?
And so what's left over is what we call depreciable basis. That's basically what you're going to be able to depreciate. And without a cost seg, we're going to depreciate that over 27 and a half years. So cost segregation, cost seg, we use those interchangeably.
Okay. So you're left with 160, right?
That's right.
Okay, and then that's going to be 20. Let's pretend this bonus depreciation didn't happen, right? So what would we call this? Year one tax savings?
Yeah.
What you do is you would take 160 divided by 27 and a half.
That's right.
You're left with, now that's your deduction. That's not your tax savings, right?
It's your deduction. That's right. And so if you're in the 40% tax bracket, between federal and state, then you take 40% of that. And you still look at that and say that's not a bad deal, right?
Yeah, it's better than nothing.
Yeah.
Okay, so then you multiply that by 40%, right?
That's right.
Okay, so you save, this is interesting. Okay,
so what I want to, while you're typing this up, what I want to make sure that we're clear on is depreciation is a deferral, right?
Yeah.
And so when we say savings, we're saving it in the current year, then you choose when to sell it, right? So you choose when you have to pay those taxes back, right? So you're basically getting a free loan from the government. That's what depreciation is. If you love free loans, interest-free loans, this is how you get it. And you get to decide when you pay it back. That's basically what we're doing here. And then there's plenty of strategies out there on how we don't pay it back on the back end, but that's too much. That's beyond this conversation.
Okay. So it's really a liquidity issue. It's about when you pay your taxes. And if you defer taxes, you're generally more liquid.
That's right.
Okay. So you could say
you can accelerate your wealth building.
Say that again?
You can accelerate your wealth building because you now have more capital to put into more real estate to continue that snowball.
Okay. Okay, so cool. A 5% tax savings year one.
Not bad.
Yeah, and
you're going to get that every year for the next 27 and a half years.
Okay, now let's do those same numbers with a 60% bonus.
Yeah, so take that 160,000 and then we're going to take that multiplied by 25%. That is the estimate. Could be high, could be low, but it's a good estimate of what the cost segregation study is going to give you in the breakdown of the various, what we call lower lived assets, right? The flooring, the land improvements, all of those things that are subject to bonus depreciation. The cost segregation is going to tell us that, right?
So
we got a $40,000.
What do we call this 40 G's?
That 40, what's that?
What do we call this 40 grand?
That's basically what is available for bonus. The $40,000 is what is available for bonus.
Okay, nice.
And then we're going to take 60% of that for 2024, and that is going to be the deduction that you would receive on this property.
What about everything that's left that's on the 27 and a half year program?
Yes, that still gets there. Now it's going to get reduced a little bit because we pulled it out, right? And then everything that's left of the 5 and 15 year also gets depreciated. So you're going to get a few $1,000s more of depreciation than that 60%, but it's negligible really when it's all said and done.
So really not even worth calculating.
No, it's probably not going to change much of it's not going to change your decision making on whether to buy the property or not, certainly.
So is your year one loss now 24?
Your year one loss is now, the depreciation from it is, yes, 24,000 is what you would expect to see there.
Okay. Oops, that was 240 I put there.
That'd be nice.
Yeah. Okay, cool. $9,600, a 20% return year one, right?
Yeah.
But that's going to only then be for year one, correct?
That's right. That's right. Now, you're still going to have depreciation in year 2, year 3. That's what we were talking about. You still have some of that depreciation there. But the majority of it, again, we're accelerating cash into your pocket today.
Yeah.
Right? You want cash a year from now, or you want it today? You want it today, right? So that's what we're doing here. The one thing that's fun here, look at that as a 100% bonus depreciation. Just for giggles, let's show them what that would look like.
Which you're predicting will come back.
I do think it will. Yeah, I do think it will.
Okay. And then let's say I buy a house this year and then bonus depreciation comes back next year. You can always take the loss then, right?
That's right.
Because if it was me and I'm not yet a real estate professional, I buy 5 houses and then get all that tax savings.
Sure. That's right.
Okay.
Yeah.
So which number do I change?
That 24 is going to go to 40.
That's right.
Yeah.
Okay. Cool. 16 grand tax savings year one.
Yeah. 32% right off the bat in tax savings back in your pocket. And that's not bad. It's not a bad start.
No, not at all. Here, let's do something interesting. Let's go over the same scenario with a Berkey with no bonus. These are interesting with the Berkeys, right?
The Berkeys it's still going to be what you purchased it for.
Is it purchase price or purchase price plus renovation?
Purchase price plus renovation, but whatever your all-in cost is. But it's still going to be, I think the difference is if the down payment is less, then it becomes interesting.
Yeah, this becomes very interesting. Okay, 75%. So your down payment here goes down to 20,000. This gets very interesting, I think. Your land is now, let me make sure these numbers are correct. Your depreciable basis is 136. Your year one loss with no bonus becomes 4595. Your tax savings is 1978, but you only have 20 grand into this house. So it's an instant 10% return.
Yeah.
All right, now let's check it out with a bonus. This is such fun with numbers.
That's how wealth's built here. A lot of people think wealth is built out in the field. No, it's built in a spreadsheet, man.
It's built with planning.
That's right, in a spreadsheet.
All right, so then I need to add in, I added in this right here, right?
Yeah, we just need to get that bonus back in there for this year.
So I take 60%. Oh yeah, that's right. So you're saying, so 130, how'd we do it over here? Available for bonus. So 25% is available for bonus, right?
Yeah.
Okay. And then what, it's 60% of 34?
Yep.
Oh, that gets very interesting. So an $8,000 tax savings and a 40% year one return.
Yeah. Now, this is where when I started the conversation off by saying, hey, during the 100% bonus depreciation era, you almost had to buy real estate.
Yeah.
Show 100% depreciation on this.
So I just take this, the 25% of 136, right?
Yeah, so it's 34,000.
Now that gets really interesting.
Yeah.
It's almost like working with Freeland Capital, you're printing your own money.
100% depreciation gives you a lot of incentives if you can get all of the real estate professional status, all that stuff down. And this is why it makes sense where you could have a lower income spouse come in and you can really accelerate your wealth very quickly, especially with 100% bonus depreciation. But you can still see with 60% bonus depreciation, there's plenty of meat on the bone there of tax savings.
So for this year, let's say here's some interesting math. Let's say your non-working spouse makes $200K a year, right? I'm in a 40% tax bracket, right?
Yeah.
And me and Susie went through this exercise probably like 2017. This was very fun. Yuck. What is that?
It's not fun.
Ew, 80 grand in taxes? Then your take home. This was really, me and Susie had this discussion back in the day, and it was like, hey, honey, you have to work, this labor has to go to our business. We can't be giving the government this much money. So your take home for a $200,000 job is really 120, right? And now I am going to put a cautionary tale on here. This is just fun with numbers. This isn't gospel.
Sure. Yeah.
But sometimes it's a fun thought experiment to do that. So if you have 14 Berkeys, you could replace it.
Yeah. The other thing is on that 14 Berkeys, your average equity in that's in 20 grand?
Let's go back to this. 30 grand?
Yeah, but you're putting 20 grand down, right? So you're
you're right.
Equity, 10 grand. So on top of the tax savings, you also built another basically $150,000 in equity in your portfolio. Ended up with 5 houses. The portfolio value is going to be over $2 million, right? Almost $3 million if they're at 200K a piece. And so that appreciating at 3% a year appreciates at about $90,000 a year. There's a lot of ways when you start trying to look at, okay, the money that I've built, the wealth that I can create over time, the tax savings that I can get immediately. Again, you got to be in a position from a family standpoint to be able to cash flow losing $120,000 in cash flow. But you can easily, if you think you're losing wealth by doing that, I don't know if that's necessarily the case for all people.
Yeah, you can make that cash flow hit sting a little bit less because you're not giving Uncle Sam as much money.
That's right.
So, well, sweet.
And if we're all trying to do the same thing, we're all trying to retire anyways at some point, right? So the faster that we can get there and make sense of it, the better.
Yeah, I agree. So Marcus, everybody in the community is going to watch this video. If they want to get in touch with you, if they want to work with you, this is something I learned this morning, gang. But I thought Marcus only wanted to work with people like me. But Marcus actually wants to work, and by people like me, active real estate businesses. But you do now have what would you call someone who's not like a CG member? What are you calling your non-CG member department?
Yeah, simple as this. We work with real estate investors and real estate entrepreneurs across the country. And so if you are in real estate, we can help you. Now, the level at which we help you varies, right? We have, to start with most of your investors, most of the people that you're working with, they could probably stand the tax planning packet. That's what we're really talking about here, which is where we come in, we do a deep dive into your tax situation, recommend all the strategies that we think could work for you. You get a list, if you will, of all of the strategies that might be able to work for you, and pick from the list and implement those. And then we can also show you from that how to implement them, help you implement them, do the preparation, and we can work your way up all the way to CFO services like Jimmy, where we're working with Jimmy and his whole team. We actually got a meeting later today to go over the entire entity structure and all of the various P&Ls and balance sheets across the entire portfolio, and helping him run that business from a profit standpoint. So yeah, we can take care of anybody. If you want more information about it, go to beckcfo.com, becfo.com. Reach out to us. We're happy to help in any way we can.
Thank you for working through these numbers, and I will see you this afternoon.
You got it. We'll talk soon, Jimmy. Appreciate you.
Hey, thanks for watching the video. If you make over $300K per year, I think my program could be great for you. We're going to find beat up houses like this one behind me that we just started rehab in. I don't know if the video is doing justice to how bad these floors is. And then let me take you through a spin here. This is the kitchen. You'll notice there is no kitchen. But our investors love deals like this because they know in 3 weeks, this is going to be a beautiful kitchen waiting for either a new homeowner or a new resident to rent. So if you're interested in investing in real estate in a completely passive manner and want someone to find the house, to fix the house, to find a tenant, or help you sell it, click the link below to book a call.